President Trump is imposing new tariffs. He says copper imports will soon face a 50% levy, just like steel and aluminum.
So, whatever happens in the US is going to have an impact globally. And certainly we've seen the impact up until today with those US prices really surging as the market started to price in the impact of those tariffs.
Within just 24 hours of Trump signing a sweeping 50% tariff on copper, the U.S. lost $4.2 billion, not in projections, but in real-time trade collapse. Canada, which supplies over 40% of America's refined copper, responded immediately by freezing all export contracts. No press conference, no warning, just a quiet pullback that sent shockwaves through American industry. Warehouses across the U.S. saw copper inventories spike to the highest levels in 21 years, not from abundance, but from paralysis. At the same time, global supplies dried up. Inventories on the London Metal Exchange plunged nearly 50% since the start of the year. And as Teck Resources and Hudbay Minerals halted shipments, the message from Canada couldn't be clearer: this isn't business as usual anymore. So is this what a great deal looks like, or has the U.S. just gambled away its seat at the center of the global supply chain? We break down the latest shifts in global markets. If that's something you care about, drop a like and subscribe to stay ahead. The chaos didn't stop with supply. Within a single trading day, U.S. copper prices surged 13%, hitting $564 per pound, the sharpest spike ever recorded. With domestic buyers scrambling to secure material, global traders saw their moment. Giants like Glencore, Trafigura, and IXM rushed to dump excess stock into the U.S. market, raking in over $300 million in arbitrage profit practically overnight. But that bubble burst just as fast as it formed. 2 weeks later, U.S. copper prices crashed over 20%, erasing all gains and plunging the market into confusion. The record-high inventories, already the highest in 21 years, turned from strategic stockpile to stranded assets. The U.S. had gone from the most attractive destination for copper to a dumping ground. And then came the kicker: the administration clarified that the 50% tariff didn't apply to refined copper, the very type the U.S. had been importing all along. American firms were left holding millions in overpriced inventory, victims of a policy that reversed faster than the market could react. You're still here, and that means you're paying attention. Show your support with a like and subscribe so you don't miss what's coming next. While U.S. markets reeled from whiplash pricing and policy confusion, Canada didn't lash out emotionally. It moved with surgical precision. Ottawa quietly approved a $1.88 billion CAD investment package to expand export infrastructure beyond North America, signaling a long-term pivot rather than a short-term protest. Instead of fighting for access to a volatile U.S. market, Canadian suppliers began redirecting flows to Asia's industrial giants Japan, South Korea, and China. Companies like Glencore started pulling operations out of the U.S. altogether, unwilling to navigate a trade environment riddled with unpredictability. Crucially, Canada is no longer content with acting as a middleman. Raw copper is now being shipped directly to Asia for refining, cutting the U.S. out of both ends of the value chain. What was once a tightly integrated North American metals ecosystem is rapidly fragmenting, and the U.S. is being quietly written out of the copper story. This pivot wasn't just symbolic, it tore through the foundation of U.S. copper supply. Before the tariffs, Canada accounted for 52% of all U.S. copper imports. Within days of the new policy, that flow all but vanished, and with it the fragile stability of America's copper-dependent industries. The U.S. simply isn't equipped to replace that loss. Domestic refining capacity meets only 5 to 7% of national demand, and plants like ASARCO, once key players, are either running at minimal output or have shut down entirely. The result is a brutal supply shock, soaring prices with no domestic cushion to fall back on. It's not just a shortage, it's a structural collapse. The U.S. is facing a dual crisis: vanishing supply and rising costs, with virtually zero ability to self-correct. As copper supplies tightened and prices surged, the impact rippled fast through U.S. manufacturing, and nowhere was it felt more severely than in the electric vehicle sector. With each EV requiring roughly 80 kilograms of copper, even a modest price spike translated into a $90 increase per vehicle. For companies like Tesla and Ford, already operating on razor-thin margins, the math stopped making sense. Major projects were frozen, costing millions in idle facilities and delayed production every single month. But the disruption didn't stop at cars. Electrical equipment manufacturers, from cable producers to transformer suppliers, faced copper cost increases between 18% and 25%. As bids became uncompetitive, contracts began slipping away to manufacturers in Vietnam and Thailand who offered stable prices and uninterrupted supply. In a clear sign of how deep the shock ran, utility companies in Ohio and Indiana formally petitioned regulators for emergency electricity rate hikes. Their reason: spiking costs for copper-based transformers and wiring. What began as a tariff on raw materials had quickly become a nationwide industrial paralysis. The copper shock didn't stop at manufacturing lines or inventory sheets. It began unraveling the deeper threads of the U.S. economy. What started as a targeted tariff quickly became a widespread drag on growth. UBS now warns that the fallout could shave off as much as 0.5 percentage points from GDP in the current quarter alone, a rare contraction triggered not by external shocks or global crises, but by a self-imposed disruption. Nowhere is the damage more visible than in housing and transportation. Residential developers report cost overruns between $17,000 and $22,000 per unit, largely due to copper-intensive electrical systems, HVAC components, and grounding infrastructure. Some projects have been paused altogether, especially in high-growth states where construction margins were already tight. The electric vehicle sector, once seen as a pillar of future competitiveness, is feeling the pinch from every angle. With copper prices factored in, EV prices are rising by $3,000 to $6,000 per unit, a hike that risks pushing the segment further out of reach for working-class buyers and slowing adoption rates just as global competitors ramp up production. The shockwaves extend beyond goods into services. Utilities grappling with volatile copper input costs are reworking budgets and delaying upgrades. Smaller municipalities already under financial pressure are shelving critical infrastructure projects that depend on copper-based materials. From the wiring in homes to the grid beneath our cities, copper underpins more of the economy than most people realize. And this tariff turned a crucial input into a choke point. The real cost isn't just inflation, it's the systemic risk created when economic policy is made in isolation, with no consultation, no coordination, and no strategic fallback. It wasn't long ago that the United States anchored the global metal supply chain, not just as a buyer, but as the coordinator of trade routes, the standard setter in refining, and the central hub where raw materials met industrial demand. American firms sat at the intersection of mining operations in the Global South, refining capacity in Canada, and high-tech manufacturing across North America. That centrality is now rapidly eroding. With one sweeping tariff, the U.S. has triggered a quiet but powerful realignment, one that's being led not by adversaries, but by longtime allies. Canada, once an indispensable trade partner, is now strategically disengaging. Instead of prioritizing U.S.-bound exports, it's forging deeper links with Asian manufacturing powerhouses, Japan, South Korea, and China, where demand is rising and trade policy remains predictable. Multinational suppliers are following suit. Major copper players are reconfiguring routes, investing in new refining facilities abroad, and drafting long-term contracts that no longer include U.S. markets. It's not retaliation, it's risk mitigation. For the first time in decades, the U.S. is no longer viewed as a stable endpoint in the global commodity flow. Trump's vision of economic sovereignty through aggressive tariffs may have aimed to restore control, but the result has been strategic fragmentation. When partners lose trust in your ability to provide continuity, they don't wait, they replace you. And that's exactly what's happening. The copper supply chain, a cornerstone of modern industry, is being rebuilt. This time, the U.S. isn't designing it. It isn't even in the room. So we have to ask, was this truly the great deal Trump promised, or a slow-motion act of economic self-sabotage that's driving America's closest trade partners away? The $4.2 billion loss was only the opening act. If the U.S. doesn't reverse course or build strategic alternatives fast, it risks being locked out of the very supply chains that will define the next industrial era, from energy transition to advanced manufacturing. Because copper isn't just another commodity, it's the backbone of electric vehicles, renewable power, data infrastructure. And once trust is broken in a trade relationship, it's not easily restored. The question now isn't just what America lost, but how much more it's willing to lose before it realizes the cost of going it alone. Appreciate you sticking with us till the end. If this content spoke to you, hit like, leave a comment, and subscribe. More critical updates are coming soon.